The industrial assembly line moves thousands of bright yellow boxes through a complex mechanical sorter. This high-volume output creates a massive stream of reliable revenue for the company. Executives gather in a wood-paneled boardroom to review the quarterly earnings reports. The charts show that chemical processing remains the most profitable segment of the entire global business. The decision to focus on film is rooted in a highly successful business model. Selling inexpensive hardware and expensive consumables ensures a constant flow of cash from consumers. In a quiet laboratory, a lead engineer adjusts a prototype device that captures light on a sensor. This early technology is bulky, and the images lack sharp detail. Management views the digital prototype as a curiosity rather than a threat. They believe that customers will never trade the rich quality of film for digital pixels. Massive chemical vats churn thousands of gallons of developing fluid every day. The company has invested billions into this physical infrastructure, making any pivot extremely expensive. A worker pulls a large industrial lever to initiate the silver coating process. This material is essential for film production and represents a significant portion of inventory. Around the world, thousands of small retail photo labs open their doors. Each one uses the company's proprietary chemicals and paper to process family memories. The incentives for middle management are tied directly to current film sales. Proposing a digital alternative would mean cutting their own budgets and reducing their headcount. A patent clerk stamps a document for a new electronic imaging sensor. While the company secures the legal rights, they choose not to commercialize the technology. Outside observers begin to notice a shift in Japanese manufacturing capabilities. New competitors are investing heavily in semiconductor production, while the film giant remains focused. The organization's culture is deeply intertwined with the science of chemistry. Chemists hold the highest positions of power and see digital as a separate industry. Warehouses are filled to the ceiling with pallets of photographic paper. This inventory represents billions in value that can only be realized if film stays dominant. A marketing team launches a massive campaign focused on the emotional value of printed photos. They emphasize that a digital file can never replace a physical memory. Local optimization leads to incremental improvements in film grain and color accuracy. These small gains satisfy current customers but ignore the shifting technological landscape. Competition in the film market intensifies as rival companies lower their prices. This price war drains the resources needed for a true digital transition. Fixed costs for silver and chemical disposal begin to climb as environmental regulations tighten. The business model depends on high volume to remain profitable. A manager chooses to invest in a new coating machine that is faster, but only works for traditional film. This locks the factory into one path. Information gaps prevent the board from seeing the rapid decline in the cost of computer memory. They assume storage will always be too expensive for consumers. The company focuses on emerging markets where digital infrastructure is still years away. They find success in these regions, reinforcing their belief in film's longevity. Internal memos warn that digital imaging is improving faster than expected. These reports are often buried by departments that fear losing their annual budget allocations. Shareholders demand consistent dividends based on the current high margins. This creates a constraint where expensive research into digital tech is seen as a waste. A strategic choice is made to create a hybrid product. This device scans film into a digital format, trying to bridge the gap between two eras. The hybrid approach fails because it adds complexity instead of reducing it. Consumers want the speed of digital without the friction of developing physical rolls of film. External competitors begin to capture the emerging market for digital sensors. Future videos examine how similar decisions shaped other outcomes. This transition highlights the risk. By the mid-90s, household computers are becoming common tools for organizing life. digital photography begins to offer a new way to share images almost instantly. The first truly consumer-friendly digital cameras hit the market. They are expensive and low quality, but they remove the need for chemical processing entirely for users. The film giant finally releases its own digital camera, but it is marketed poorly. They still want customers to print every photo using their expensive paper. Internal metrics still show film as the dominant revenue source. This data creates a false sense of security, while the underlying market is shifting rapidly. The company begins to close its oldest chemical plants to save costs. This is the first visible sign that the billion-dollar infrastructure is becoming a liability. Billions in market valuation begin to evaporate as investors realize the company has missed the window. New tech giants are now leading the imaging world. Thousands of retail labs close down as digital cameras become the standard. The network that once supported the company's dominance has completely collapsed. The company attempts a desperate pivot into digital printing services. They hope to leverage their brand name to survive in a much more competitive market. Assets are sold off to pay down massive debts accumulated during the transition. Iconic patents are auctioned to competitors to keep the remaining operations afloat. The workforce is drastically reduced through series of layoffs. Experts in chemical engineering find their skills are no longer needed in the digital world. The decision to protect the high-margin film business was rational based on existing data. However, the scale of the technological shift was beyond their models. Systems often multiply the outcomes of small choices over long periods. What appeared to be a safe strategy became a trap as the world moved on. A final shipment of traditional film leaves the factory. This marks the end of an era where chemistry defined how the world captured its history. The legacy of the company remains in the form of thousands of patents. These digital foundations were built by the same firm that chose not to use them. The institutional memory of the firm is now scattered across the industry. Many former employees have helped build the very digital giants that replaced them. Large-scale financial consequences often stem from reasonable local choices. The desire to maintain existing success can prevent the adoption of necessary future changes. A new generation of cameras is designed without any physical film in mind. They are smaller, faster, and integrated directly into other consumer electronics. The cost of the decision is not just measured in lost money. It is also measured in the loss of global influence and technological leadership. History shows that systems multiply outcomes based on initial incentives. When those incentives are misaligned with progress, the results are often irreversible and extremely costly. The industrial halls remain quiet as the system continues to carry the cost of past choices. The process of change continues elsewhere, leaving legacy structures behind.